Welcome. We are following this book, Chapter 10, Plant Assets, Natural Resources and Intangible Assets. This is the 5 learning objectives. Today discuss learning objective 2, applying depreciation methods to plant assets. First one we discuss on depreciation. What is depreciation? Depreciation process of allocating to expenses the cost of a plant assets over its useful or service life in a rational and systematic manner. Suppose we have purchased an equipment suppose 1000 and its service life or useful life suppose 5 years and this is the cost price $1000. So after dividing 5 we are getting $200. So we call this is the process of allocating. That means this $200 this is the process of allocating to expense the cost of plant assets, okay, over its useful life. 5 years and per year will be $200, okay. Year 1, year 2, year 3, year 4, year 5. So every year it will be $200 for every year. So we call now please look, process of allocating to expense the cost of a plant asset. This is plant asset and process of allocating to expense. Allocating expense, that means 200 taka. This is the depreciation expense. The depreciation expense over its useful life. Useful life here 5 years. In a rational and systematic manner. Rational and systematic manner, it depends on company rules and policy. Process of cost allocation, not asset value, not asset valuation. That means this depreciation, this is the process of cost allocation. This is the process of cost allocation. That means already we have told regarding this matter, process of allocation to expense or process of cost allocation. This one, that means this one, this 200 every year we have allocated, not asset valuation. This is not asset valuation, this is wrong, this is okay. Applies to land improvements, buildings and equipment. Already we have seen that our plant asset 4 types: land improvements, building and equipment, and another one is land. But we do not charge any depreciation on land. It will be appreciation, not depreciation. Depreciable because the revenue producing ability of asset will decline over the asset useful life. You know, when we purchase a new machine, here this is the first time, first year, its producing ability will be very high, but when it will go second year, third year, fourth year, fifth year, it will be declining, okay. It must be declining. So its useful life suppose 5 years and first year and 5 years or last year, if we compare the times, we will see that the revenue producing ability of asset will decline over the asset useful life, okay. So it's all over on depreciation. Now factors in computing depreciation. We have 3 factors to compute the depreciation. Number one factor, cost. Number 2, useful life and salvage value. Also cost, all expenditures necessary to acquire the assets and make it ready for intended use. Already we have discussed it. Suppose when we purchase delivery truck, we need cash price of truck, we need lettering, we need the transportation cost, we need the sales tax, etc. regarding this truck. Number second, useful life. Suppose estimate of the expected life based on need for repair, service life and vulnerability to obsolescence, okay. So this is a main point here. estimated of the expected life. Estimated, suppose this truck will be run 5 years. Okay, 5 years. So these 5 years depend on or based on the need of repair, how frequently repair of this truck is, service life, and vulnerability to obsolescence. Okay, salvage value. So after using, that means after 5 years. After 5 years, this is year 1, this is year 2, this is year 3, this is year 4, and this is year 5. After 5 years, suppose we have purchased this trucks $1,000. Here we are getting salvage value, suppose $100. So we call this is the salvage value. So here depreciable amount will be $900. So 5 180 per year depreciation. This is the depreciable cost. First year, second year, third year, fourth year, fifth year, every year will be $180. Okay, and this 100, this 100, this is the salvage value. Okay, or residual value or scrap value, estimated of the asset's value at the end of its useful life. Okay, 3 factors in computing depreciation. This is the 3 factors. 3 factors in computing depreciation. Already we have discussed. Okay, thank you. I'll move to next slide. Depreciation method. Actually, we have 3 types of depreciation methods. Straight line method, units of activity method, or declining balance method. Okay, throughout the world we have seen that this is 83% straight line method, and this is the 4% declining balance method, and finally 5% units of activity method, and others. We have others methods. So this method is very much popular. Okay, so management selects the methods. This depends on management which methods they will follow. It believes best measures an asset's contribution to revenue over its useful life. Okay. So already we have told this matter. We have 3 methods: straight line methods, units of activity methods, declining balance method. Okay. So use of depreciation methods in major US companies. I move to next slides. Now depreciation method. Here we have an illustration. Please look this illustration. This is very important to understand these 3 methods. Here illustrations. Parts florist purchased a small delivery truck on January 1, 2017. Okay, so this is illustration 10.7 delivery cost or delivery truck data. So cost $13,000, expected salvage value $1,000, estimated useful life in years 5 years, estimated useful life in miles 1 lakh miles. Okay, so required compute depreciation using the following: A, straight line; B, units of activity; C, declining balance. Okay, so first on straight line. Please keep in mind these 4 points. That means cost, expected salvage value, estimated useful life in years, estimated useful life in miles. Okay, straight line methods. Expense the same amount of each year. Expense the same amount in for each year. Suppose here depreciable cost equal to cost less salvage value. Okay, formula for straight line methods. This is the main formula. Cost, according to question, we have cost $13,000. Okay, salvage value $1,000. So cost, this is cost less, that means this is minus or subtract salvage value $1,000. So it will be depreciable cost. $12,000. Okay, then depreciable cost $12,000 divided useful life. So here useful life 5 years according to question. Then annual depreciation expense 2,400. Suppose we can show a picture here. When we purchase that the equipment, at times delivery truck, this is delivery truck. When we purchase this delivery truck, the cost price $13,000, and after 5 years it shows $1,000 as a salvage value or scrap value or residual value. And so within 5 years our depreciation total $12,000. That means this is $12,000, and if we divide 5, it will be 2,400. $2,400 5 years for each year. This first year, this is second year, this is third year, this is fourth year, this is fifth year. Okay, thus every year it will be 2,400. I think everybody is clear. Move to next slide. Illustration straight line. Okay, straight line. This is the receivable cost 12,000 and rate 20%. Rate 20%. How could we calculate this rate? Here, always. Okay, rate 20%. Rate 20%. Thus we can calculate 100 divided by 5 equal to 20%. Divided by 5 means this is 5 years. Suppose 100 divided by 10 years, 10. That times it will be 10%. Okay, it will be 10%. So this is the calculating point. This 20% we have got just like this. Annual depreciation expenses just 2,400 are accumulated depreciation, this same figure, and finally it will be our book value. So how could we get this book value? Book value equal to cost minus accumulated depreciation. The cost 13,000. Earlier I expressed this matter, or according to question we have this on, and 2,400 this is first year depreciation. Then we are getting this figure. Okay, number 2, journal depreciation expense 2,400 and accumulated depreciation 2,400. Okay, so here this figure, that means depreciation expense, this is annual depreciation expense on 2,400 and accumulated depreciation 2,400. Okay, then depreciable cost 12,000, rate 20%, annual depreciation expense 2,400, accumulated depreciation, just addition this figure, and we are getting this figure 2,400 plus 2,400, we are getting 4,800. Okay, so this is book value now 8,200. That means 10,600 minus 2,400, we are getting this figure. Okay, and the same way 20%, 2,400, just addition this figure 4,800 plus 2,400, 7,200, and this is 5,800. And residual cost 12,000, 20%, the same, and finally 1,000 will be our book value. Okay, so this is the discussion on straight line method. Okay, move to next slides. Straight line, suppose we have purchased this delivery truck on April 1. So you know that when we purchase our delivery truck on April 1, April to December, okay, January, February, March, this is 3 months, and here we have 9 months, okay, 9 months. This is the partial year, not full year. Full year 12 months, full year 12 months, okay. So depreciable cost will be 12,000, 20% then 24,000. Here it will be partial, that means 2,400 into 9 by 12, 2,400 into 9 by 12, then we will get this figure, clear. And this is accumulated depreciation, and every year, so that means 2018 to continue 2020, these 5 years the same figures, okay, same figure. And here this is 2012, 2022, okay. This is for 3 months, because of this will be run for 5 years. Please look here everybody, for 5 years, 5 years starting 2017 April 1, 17, 18, 19, 20, 21, okay, and 22 it will be finished. 22 we are getting only 3 months, so it will be 3 months depreciation. 3 months depreciation, 2,400 into 3 by 12, 3 by 12, so we are getting this figure 600. That's when actually this 3 month and this is 9 month, and if we add these two figures we will get 2,400, like 1 year depreciation, okay. I think everybody is clear. So this is accumulated depreciation, this one plus this one, we are getting this one, and 2,400, 600, then 600, then 2,400, 9,000, 2,400, 11,400, and 600, 12,000. This is the total depreciation, okay. I think everybody is clear. Now straight line depreciation on January 1, 2017, Iron Mountain Ski Corporation purchased a new sono grooming machines for $50,000. The machine is estimated to have a 10-year useful life. This is the 10-year life, 10-year life with 2,000 salvage value. This is the useful life of 10 years. What journal entry would Iron Mountain Ski Corporation make at December 31st, 2017? This is January, this is December. For 1 year, we need to be pass a journal. That means how would Iron Corporation make at this for journal make, and if it uses the straight line method of depreciation, okay. Very good answer will be our depreciation expense, accumulated depreciation, it would be. That means please look here everybody, we have purchased this machine $50,000, $50,000, and it will be run 10 years. 10 years. And after 10 years, it would be our salvage value 2,000. It's our salvage value, okay. So after 10 years, it's our salvage value. So depreciable cost will be 50,000 minus 2,000. So salvage value will be 48,000, okay. So 48,000, and it will be run 10 years. That means useful life 10 years divided 10. That times we will get this figure. 40,000 by 4,800. Okay, this one. Okay, I think everybody is clear. Now, units of activity methods. Companies estimate total units of activity to calculate depreciation cost per unit. Estimated total units. The estimated total units according to question we have got 1 lakh. Estimated total units 1 lakh units according to question. Can you remember it? Yes. So to calculate depreciation cost per unit, expense varied based on units of activity. Suppose this problem we have several years. Years 1, 2, 3, 4, 5. Okay. So every this 1 lakh just for 5 years units, for 5-year units, this one lakh. So this year, and this year will not be same units. So expenses varied. That means varied on units of activity. That means units of activity, suppose you can here 10,000, here 20,000. So expense, depreciation expense will not be same here and here. And then depreciable cost is cost less salvage value. Residual cost is cost less salvage value. Okay, so now we will show these methods. We'll discuss these methods now. Residual cost 12,000. We know this method, and then units of activity 1 lakh miles, and depreciable cost per unit just after divided. This is divided. We are getting $0.12, and depreciable cost per unit. This one, the same figure, and multiplied by units of activity during the year. During the year, 15,000 miles, and annual depreciation expense 1,800. That means this is the first year miles. This 15,000 miles first year. We have 5 years. So first year 15,000 miles. Okay, please look here. Miles driven 15,000 year, cost per unit $0.12. Annual depreciation expense dollar. That means after multiplied, we have got it accumulated depreciation, this figure, and book value 11,200. That means our cost 13,000. Cost $13,000 minus 1,800. Then 1,800. So then we will get this figure. Okay. Next, depreciation expense, the accumulated depreciation. That means this is our depreciation expense, and this is accumulated depreciation. Okay. Number second, miles driven 30,000, cost per unit 12, $0.12, and annual depreciation expense just after multiplied this figure and this figure, we are getting this figure. Okay? And accumulated depreciation, just addition, and just like this we will get all figures. Okay, I think okay. And accumulated depreciation, just this figure, and then addition this figure, we will get this figure $5,400. Then we will add this figure $2,400, and then we will get this figure, and we will add this figure, and we will get 10,800. And after adding 1,200, we will get $12,000. Okay, so this is the book value, and finally we get $1,000. This is the book value. That means this is the salvage value, or scrap value, or residual value. Okay. Okay, next, declining balance method. Declining balance methods, just declining, sometimes we call it double declining balance, because of 100, and this will useful life 5 years, so it will be 20%. But declining balance method, or declining balance method, double declining method, it will be double. That means multiplied by 2. That means it will be 40%. Okay, 40%. So here accelerated method, decreasing annual depreciation expense over its useful life. Okay, decreasing annual depreciation expense over its asset useful life. Twist the straight line rate with double declining balance. Twist, that means it will be multiplied by 2. That means we call it the twist. Okay, the straight line rate 20%. Twist the straight line rate, that means twist the straight line rate. That's 2 times. And double declining balance. Sometimes we call double decline. That means here 20%, here it will be 40%. And rate applied to book value. So this is 13%, declining balance 40%. Thus annual depreciation expense will be $5,200. Okay, now move to next slide. This is the beginning book value, $13,000, declining balance rate 40%, annual depreciation expense 5,200, accumulated depreciation this same figure, book value 7,800. Okay, and this is the depreciation expense, this is the depreciation expense debit, and accumulated depreciation this one credit. Now beginning book value, this one will be beginning book value. Please look here, this is book value, and the same amount will be here, the book value. Okay, and 40%, then this figure, and then it will be book value, the same book value. Okay, and like this we'll finish this, accomplished this recurring balance. Okay, so actually this figure $685, $685, just here 674, computation 674. But to keep this figure right, that means $1,000, just we have calculated this figure, that means a round figure. That means 1685. We keep this 1000, so after subtract this figure we will get 685. So this 685, this one, annual depreciation expense. Okay, I think everybody is clear. Depreciation method, partial year. Okay, the before in our straight line method I discussed on this matter, so again I will discuss it. Please look here, this is for 9 months. Okay. This figure, this is the current year expense, current year annual depreciation expense 472. That means please look here, this is 12,000. Keep this 12,000, just current year expense we have shown here 180. Okay, 180. That means these two figures, if we subtract 0 to 12,000, is 180. This will be 180. This is 180. Thus after subtract this figure from this figure, we'll get this 180. Okay, this is the balancing figure you call. Okay, so here this is the beginning book value, and then declaring balance rate 40%, and the same matters. Just this is 9 months, and this is for 3 months. Okay, this one is 3 months, and this one is for 9 months. And this is the accumulated depreciation. Okay, I think everybody is clear. And comparison of methods. Year 2017, 18, 19, 20, 21. We look here, straight line, the same method, units activities, just dimension activities, and declining balance, just this one. So here depreciation expense, straight line, declining balance, it's a graphical presentation. Okay, so it's all. Thank you so much for joining with us.